Welcome to our ATEL Summer 2022 conference. Dear members, dear friends, dear treasurers, we hope you will enjoy the different presentations and speeches we've prepared together with our partners. Our partners for this summer conference are HSBC, Arendt, PwC and Visa. Today the conference consists of four main parts. The subjects we will address are very interesting, and according to the recent European EACT survey or the global PwC survey, they are key priorities for corporate treasurers. Nevertheless, the order of the presentation does not reflect exactly the order of priorities that have been classified by the treasurers. But now let's start with the first set of presentations by HSBC. HSBC will talk about how to navigate a new uncertainty, rising interest rate, risk and the return of inflation. In the following series of short presentations, you will have a first panel with Nick Ashton, country head of Luxembourg HSBC, Global Liquidity and Cash Management, Myriam Radi, Senior Liquidity Manager, HSBC, and Sijia Douan, Senior Sales Manager at HSBC Luxembourg. Then in the next part, we will welcome Raphael Zeytoun, Managing Director, Head of Global Markets and Corporate Sales, Christopher Hadfield, Investment Analyst at HSBC Global Research, and Dominic Bunning, Head of European FX Research at HSBC Global Banking and Markets. Guys, the floor is yours.
So, good afternoon and welcome to our panel. My name is Sijia. I'm the Senior Sales Manager in Global Liquidity and Cash Management in HSBC Luxembourg. Today, I'm joined by my colleague Nick, Country Head of Global Liquidity and Cash Management in Luxembourg, and Miriam, our liquidity specialist based in Paris. Today, we are going to talk about the new uncertainty. So, I remember the same time last year, we're still talking about how to navigate through the low interest rate environment. I guess very few of us would have predicted that the several central banks had increased the interest rate in the past few months. And in addition to the higher inflation pressure and the expectation on even higher interest rate and the disrupted logistic and supply chain, I think all the elements put together that making our life today less predictable than before, right?
Absolutely.
Yeah, so that's why we're talking about this new uncertainty. And Nick, so during your recent client conversation with the treasurers, what about the common concerns or questions they raised in the current environment, and what are the tools we can offer to help them?
Yeah, thanks, Sijia. Yeah, it's really exciting to be here to talk about it. So I think what customers are telling us is that the cash flow forecasting and being able to predict what's happening is becoming more important. I mean, there is more volatility in the market. The opportunity cost of leaving cash around is sort of coming back. I mean, I think that's one of the themes that's coming up a lot in some of the conversations we're having. Some of the conversations, they're not new conversations, but they're the same conversations we had in the past, but things are becoming more pressing again because, in a rising interest rate cycle with that increased volatility, the cash managers, the treasury managers are having to maybe pay a little bit more attention, or things a bit more urgent than they were.
Yeah, absolutely. And we also seeing very interesting that some old, I would say, classic back to normal banking productions are back to the table. So, for example, some of the liquidity management solutions we see discussed again. And but we want to one element there is very interesting. Is also those products, traditional products, are not the old version we are used to, and thanks to the technology, the development of technology, and they are the newer version. So one example is, I remember last year we introduced the API here, and after 1 year we see more corporate treasurers are using API to initiate payments, to generate real-time reports, to have real-time visibility on their account. And another example is the SEPA instant payment. We just launched early this year, and some clients are already combine using API to initiate payments through the SEPA instant channel. So this really gives our customer a kind of a seamless experience, digital experience, and also this could help to enhance their customer journey as well. Yeah, so that's a very interesting observation we had. Miriam, being a product specialist in liquidity, based in Paris, you must have seen a lot of regional or even global treasury centers here in Europe. So, what are your recent client conversation and discussion you had that you would like to share with us?
Yeah, thanks, Sija. You're right. From a regional and European perspective, we do still see as a key driver the need to manage liquidity efficiently to get real-time visibility across all the accounts, I would say globally. And that comes back to your point earlier on, getting access through API and as well more accurate liquidity view on the cash positions. I think this remains a key driver for all the corporate and organizations, clients are meeting with the teams here in Europe, I would say. And this goes along with a liquidity structure, of course, which provides consolidated access, right, to the funds to optimize as well the excess cash internally. So to your point earlier with Nick, nothing really new, but within this very volatile rates environment and post COVID times, I would say, which has been quite stressed times for our clients, the need is even more, I would say, there to have the liquidity structure and digital tools, that will help optimize the cash needs of a company today. And I would say that in terms of uncertainty, and Nick mentioned this earlier, and that's a very fair point, it's even more, I would say, important than ever for treasurers to have an accurate and timely forecast of their global liquidity positions, not only the short term, but as forward as possible. And we've seen these needs very kind of present over the last few months, post-COVID, I would say, namely, even if this is part of BAU for treasurers and finance teams, of course, cash forecast was not born with the COVID times, of course, but I'd say that it makes these needs even more accurate during this type of times, and we're challenging times. So just to maybe add on this, bearing in mind that our corporate challenges, and as part of the bank's drive for digital innovation, in a way, HSBC have partnered with a leading fintech provider, and we've launched a next generation cash flow forecasting solution to service corporate needs within this context, actually.
Thank you, Miriam. That's very helpful. And my personal experience talking to the treasurer, for example, last year when the interest rates are low, very, very few of them were talking about, for example, notional pooling, because there's no benefit for them to do that. But start from this year, more and more come back and want to know more, because obviously the interest rates is so high, especially for US dollar and for GBP, and they want to take benefit of the current situation. So I don't know if you observe the same in your client conversation.
Absolutely, Sija. Sorry, and that's a very, very good point. As you know, of course, and we all know, multi-currency notional pooling is here and there since ever. It's not a new solution to your point, and we do offer, of course, this solution out of Luxembourg along with a physical cash pooling solution, of course. But it's true that notional pooling is getting more attention, I would say, recently, lately, and especially since the rise on the dollar and GBP. So we see our clients, I would say, from a regional perspective, right? Considering more national pools, and the reason is quite straight, I would say, for this. As you know, it's a national pool is relevant for a mix of fluctuating debit and credit balances, right, across the currencies, as it allows for interest to be optimized by offsetting nationally credit and debit position held in different currencies. And within, I would say, a better and increasing rate environment, it makes the offset more interesting, of course, for our clients so that they can get improved interest conditions, namely on the debit balances that are offset, and hence, I would say, leverage on the existing internal cash available versus, of course, external financing for working capital purposes. So yeah, definitely this new environment may create new ways to optimize liquidity for companies, namely through the use of notional pooling, though this needs to be assessed, of course, on a case-by-case basis, as it depends on the environment of the clients, the currencies and countries in scope.
Okay, thank you. And if I understand correctly, you were talking about one client using, for example, a hybrid solution which combine both notional pooling and cash concentration. That's really interesting. Do you have like a slide or structure you can share with us how the structure looks like?
Sure. And we may just, if you don't mind, pull it out on the screen here now for you and for our attendees today. So this is how I would say most of the structures we see in practice regionally with our clients at HSBC. That would be, as you said, Sija, much closer to what we call hybrid solution, right? Where with a physical cash pooling structure, with accounts opened locally in each country, each currency where feasible, of course, from a regulatory perspective. And those entity and local accounts will sweep to the master accounts held, for instance, here in Luxembourg, right? And wrapping up this physical cash pool structure on top of the physical cash pooling structure, we would set up a notional pool to allow for the offset of the interest rate and balances notionally across the currencies. And all this usually supported by digital tools. So I would say usually, portals where they can, our clients access their cash position real time. So that would be, I would say that is the most, I would say, common structures we're seeing with our clients, though these are very kind of phased solutions, right? Clients would take it one step at a time, and that's what we would advise as well, depending on the complexity of the environment from our clients. So it's a long journey. It seems very simple on the graph, but it is a long journey. That's where we support our clients with.
Yeah, absolutely. I mean, one of the things that you made a really good point there, Miriam, is that I think that's a complex structure, and that's like a final position that you can end up. So one of the things that is really interesting for me is that depending on companies where they are in their sort of journey with Treasury transformation, some customers may be very advanced down that with their plans, and actually they can take things to that next level. Maybe they've got a cash concentration structure and you put the notional pool in over the top of it. Other clients maybe are still using Excel spreadsheets and manually forecasting and bringing the cash through individual payments. So there's maybe an opportunity there just to simply look at the where the time and energy is going and automate some of that. And there's a lot of talk about automation in the market, and they're talking about robotics and various things. But I think at a simple sort of day-to-day level, treasurers can look at what they're doing and say, actually, how much of that can we automate using the cash concentration? And then, our solution is very, very flexible. So we can do daily sweeps, weekly sweeps, monthly sweeps, and then encourage people to think about the time and the energy that takes away from their team. And we know in Luxembourg, corporates keep telling us that talent is really hard and it's hard to recruit and everyone's got a lot of work to do. So actually having that ability to automate takes repetitive work out from the team to free up them to do something a bit more valuable. And the other part of that being as well, that there's a level of operational risk every time you make a payment or an instruction, and somebody has to be involved. By automating it, you actually take out and mitigate some of that operational risk. So it is a good risk management tool as well.
And I think it also depends on how much cost company is willing to pay in terms of pricing and the whole journey, and also a lot of internal discussion, external discussion, talk to your tax advisor, etc. So I think it's really like Miriam, Nick, you mentioned that it's not like a one step to the final destination, but more like a step-by-step conversation here. We are here to help our customers as well. So, and Miriam is also, I think, based in our specialist in liquidity products. She has also helped a lot of customers discuss this structure, and we know that each of the liquidity structure is tailor-made because of the industry, because the complexity of the company setup. Even depends on which locations they have operation with. So we are here to help you. And if you are interested, if you want to know more, feel free to contact us. And we are more than happy to set up a conversation and to go through the journey together with you.
Absolutely. And I mean, we talk on behalf of our colleague Miriam as well, but it's actually this is what we do. I mean, this is the whole point of our business really, and that's why we're here on the ground in Luxembourg, happy to have those conversations, and as I said, Miriam is also happy to get the train over from Paris and join. And I think to that point, Sija, it's having that conversation, working on the conversation and working on what is actually best, because every single customer is different. Every customer has different needs, and we can help. We can help all customers, and we can design those solutions, and we can do as much or as little to help people along that journey. And we do know corporate treasury is a difficult business. Everyone's always overworked. It's really a struggle, and our mission really is part of it is to help corporate treasurers do their job a bit easier, a bit quicker, a bit cheaper, really. So we're here to help.
Absolutely, and I think it's also important that we see many cases. We talk to treasurers from different industries, and there's a lot of similarities in each of the different industries. So I think we are also happy to share what the other players are doing in the same industry. So there might be something that you could learn from, and you could share their experience.
Yeah, best practice is definitely a key point, Sija and Nick, and you're absolutely spot on. I think that's what we are really keen on sharing as well at HSBC with our clients, to help them as well kind of streamline their thoughts, right? And to your point, Nick, earlier as well, and Sija, this preliminary work, that we do hand in hand with our clients is key, and more than happy, of course, to be, spending time with the clients, whether in Luxembourg or any hub, of course, in Europe, to go and screen the needs of the client, the typical environment, because even if it's a kind of a standard solution, right? Physical cash pool or national pool is our very known and old liquidity management tools. Still, the key challenge is to set up what is fit for purpose for each client. And this requires time and investment and commitment, and that's where we're ready to kick off with our clients in Luxembourg.
Absolutely, and I think you mentioned it before, Miriam, and Sija, you said the same as well. So some of these tools and principles have been around for some time, but exactly as you said, Miriam, there's been investment, there's been digitalization, the way that we work with customers from an integration perspective, and the way that we've developed some of the front end and reporting really does leverage the improvements in the digital space. So maybe if some treasurers may have looked at some of these things a few years ago, last time the interest rates were maybe a bit higher, and decided they didn't really meet their needs, or they didn't really find that it fitted particularly well. Because we've leveraged the digital technology, things are different this time around. So I think it's fair to say, have a look again, and maybe you might like it more than you did last time.
Absolutely. Okay, I believe it's approaching the end of our section. So to wrap up our section, is there any final comments, Mira and Nick, you would like to say to our audience?
Sure, thank you, Sija. I just want to reinforce the fact that we are available and remain available to discuss any tailor-made liquidity solution to fit the corporate needs.
And Nick?
Yeah, I think the point we made is a really good one. There's a lot here. There's a lot here that we can do, and as Miriam said, we're here to help. So please, talk to me, talk to my team. That's absolutely what we're here for, to support corporate treasurers. And just that final point really is that there's something we can do. You don't have to do the whole thing in once. Mm-hmm. And if treasurers feel that they just want to make that first step towards automation or digitalization, we can help in a relatively small way, all right the way through to a full-blown hybrid notional pool solution. So don't be afraid to start, even if you're not ready to sort of go the whole way in with a sort of centralized liquidity solution at the moment.
Thank you. Thank you, Nick. Thank you, Miriam. Thank you very much for joining our section. Have a nice afternoon.
Hello, I'm Chris Atfield, European Rates Strategist with HSBC Global Research. I'd like to speak briefly to you today about the prospects for the ECB rate hiking cycle. I'd like to make 3 points. My first point is that this will happen fast. Previous rate hiking cycles from the ECB prior to the sovereign debt crisis were well telegraphed. The market priced in that the ECB was going to act ahead of time, and it was content to stay 3 to 4 hikes ahead of the ECB with no destination in mind. So a gradual cycle of rate hikes. And since the sovereign debt crisis, there have been no hiking cycles. Even in 2018, when the Fed was hiking, expectations did not translate into action from the ECB. Now, we have expectations like never before, as shown on the chart. Even 6 months ago, it was far from certain that the ECB would be hiking at all. But as expectations swung fast, so has the realization that this will be a short, sharp hiking cycle, not a long grind higher. The market is therefore forced to price in the end of the cycle before it has even begun. But this endpoint is highly uncertain, and this points to rate volatility as markets respond to swings in inflation by pricing in at different endpoints and a faster or slower hiking pace from the ECB. The one rule seems to be that the faster they go, the further they will get. Although the news is focused on the size of individual hikes, this matters most for short maturity rates. For 10 years and above, the terminal rate instead matters, where the final destination is. My second point is that we don't think that the ECB's hiking cycle will look like the Fed. Market pricing, on the other hand, is following the US. This is because the ECB has given us relatively little guidance. They prefer to pursue a policy of maximum optionality. The Fed has signaled it will move into restrictive territory before easing later, and this is priced into the market as a hump, which you can see from the chart. On the other hand, the ECB has consistently said that it's on the path to normalization. There's no hump, just a return to the market level of equilibrium. We think that markets may be disappointed going into 2023. We see 2 main risks to the ECB hiking cycle. The first is growth, that Europe may go into recession, and this includes the risk to gas supply disruption. The second is that market fragmentation could cause the ECB to pause. This is when non-core spreads widen. We think that the ECB has an unspoken mandate which was made clear after 2012, which is to keep the euro intact. Fragmentation is how the ECB refer to the problem that non-core yields like Italy are moving higher, faster than core yields like Germany, as the market prices in higher rates in the future. This leads to spread widening. The problem got bad enough that the ECB had a rare ad hoc meeting on the 15th of June to discuss this. Their problem is that controlling spreads by buying bonds goes much better with easing policy than tightening. An example of this is their QE program from 2015, and also the Pandemic Emergency Purchase Program from 2020. This had an explicit mandate of both to control spreads and also to raise inflation. Now, ECB needs to hike rates to control inflation, but it still needs to have a way of containing spreads. It's announced a new anti-fragmentation tool, and we think that this will be a focus for market concerns. Many questions are currently unclear, and it's scheduled to be unveiled at the 21st of July ECB meeting. Although attention is paid to 10-year spreads between Italy and Germany, we think that the short end, 2 years, can be a better indicator of stressed markets. As you can see from the chart, in the times of exceptional stress, those are the ones that spike most. So to summarize, the hiking cycle will happen fast. The ECB is not like the Fed, and market fragmentation matters. Thank you.
Hi, I'm Raphael Zeintoun, and I'm heading HSBC Continental Europe Corporate Sales Team. I'm happy to be with you through a video to discuss the navigation of the new uncertainties we all face, rising rates, and potentially the return of inflation. When we talk about inflation, it's always important to note, where does that inflation come from? The inflation comes from two factors. The first one is COVID in Asia is not finished yet. We still experience some lockdowns here and there, and therefore the supply chain issues we have faced since 2019 are still there to a lesser extent. The second point, as we all know, is the war between Russia and Ukraine, which has disrupted commodities and food markets as a whole globally. So when we talk about that inflation, and having said that, we need to determine the difference between the US inflation and the Eurozone inflation. For example, the structure of inflation in the US is due to about 25% to 1/3 to the price of energy. The rest is the price of services and the price of food. In the Eurozone, it is a different picture. Indeed, 2/3 of our inflation is due to the price of energy. So on one point, we could say that US has a genuine inflation, while Eurozone has an imported inflation. So let's place ourselves in the foot of the European Central Bank. Will rising rates be a great tool to fight an imported inflation? That's not true. When you rise rates, you make your investment more difficult. You make your growth more difficult. But it's not sure that the inflation you imported is going to decrease. What would be good for the European Central Bank is to have the euro going up, because as euro is going up, then the impact of inflation within the region will diminish. But rising rates in an environment where everyone else is rising rates does not guarantee to have an impact on your currency. So as you can feel, the European Central Bank is hesitating, just like all of us. The other framework we have uncertain at the moment is it feels like we are entering a term which is exactly the reverse of the trend that we have had for the past 10 years. Indeed, in the past 10 years, we have had quantitative easing. Now we have quantitative tightening. We have had stagnation. Now we have inflation. We have had tech bull, everyone willing to invest into new digitization plan. Now we have tech bears. Look at Netflix recently. We have had low wages in the Eurozone. As I speak, wages are only up by about 1.5% on average, while in the US, it's already up by 6% minimum in order to cope with the inflation. So we have had low wages in the past 10 years. Now wages are rising, which lead to we have had high margin in the past for our companies, and now we have a compression of margin. That is within this framework that we have to work within the next few days, months, or even years. There is no certainty, indeed. The only thing sure at the moment is that we need strong treasurers, we need strong finance team to follow the market, to follow the development of the markets, whether it is in FX, whether it is in rates, whether it is in commodities, so that you can feed your top management in order to take the appropriate decision for each and everyone. Thank you very, very much.
Hi, I'm Dominic Bunning, Head of European FX Research at HSBC, and I'd like to take a few minutes just to talk you through how we're seeing the landscape for currency markets through the rest of 2022. Now, the last few weeks and last few months even have seen quite a lot of shifts, particularly in terms of rate expectations, with market expectations driving much higher in terms of how much central banks are expected to tighten. And that's come about because inflation has been much higher and much more persistent than people were expecting previously. But the challenge facing policymakers is that the high inflation that we're continuing to experience is also coming at a time when growth is starting to turn more negative. And that is something that is going to make it a very tricky path for policymakers to navigate through the course of the months ahead. So in terms of what that means for FX, well, we've really been thinking about two broad drivers of currencies through the last year, and we think that will continue over the next 6 months as well. And what it is ultimately what's happening to global growth, and therefore what's happening to sentiment around global growth, global trade, and risk appetite. That's the sort of first part of the equation. And the second part of the equation is which central banks will be able to deliver on the scale of tightening that is priced into the market. So who can actually provide those rate hikes that the market is currently expecting. So on the growth front, as I mentioned, we're already seeing signs that growth is deteriorating, and actually deteriorating much faster than many people were expecting even a few months ago. And when we put that into context of what's happened historically, slowing global growth cycles tend to be very positive for the safe haven currencies, the currencies like the dollar, where you've got a big but relatively closed economy, also currencies like the Japanese yen, the Swiss franc, and to some extent the renminbi in China. Those currencies offer some of the safe haven protections against slowing global growth that other smaller currencies maybe don't offer. And therefore, it's a pretty tricky environment, we think, for currencies like commodity currencies or some of the emerging market currencies. The global growth backdrop generally looks like it's continuing to soften, and that will be quite supportive for the dollar and for those other sort of safe haven type currencies. Now, what could change that would be, some sort of big fiscal stimulus in China possibly, or in Europe, where we get a really big shift in terms of the growth drivers. But for the time being, that doesn't seem to be coming through. And actually the downside risks to growth appear to be rising because we've got both tightening monetary policy, which I'll talk about shortly, and the inflation, which is squeezing consumers, particularly in this part of the world, in Europe and the UK. And so that ultimately makes for quite a tricky growth backdrop. And we think that favors the dollar in the months ahead. The second part, as I said, is about monetary policy. Who can deliver on the tightening that is priced in? And in this sense, we also think the dollar stands out because we think the Fed has the ability to actually deliver a much bigger and longer lasting tightening cycle than many of the other central banks around the world. When you look at the US growth story, yes, it's been slowing recently, but overall it's still more resilient than much of the rest of the world. Inflation is much more broad-based, and the Fed continues to deliver on a relatively hawkish policy path. Now, other central banks have been trying to do a similar thing and to some extent catch up with that Fed path, but they haven't been doing so as aggressively. And ultimately, that comes down to the more challenging growth inflation backdrop they face. So in the UK, for example, the BOE, although they started tightening before the Fed, have been much slower in the way in which they've tightened. And that's because growth data is deteriorating and they don't believe they can deliver the scale of hikes that is priced in to the rates market. And that ultimately is something that could weigh on sterling in our view. Similarly, in Europe, it's not just that the growth inflation mix is very challenging, and that might make it hard for the ECB to hike to the same extent that the market is pricing, but the ECB also has to factor in what they call fragmentation risks, the risks of bond yields in the peripheral nations widening out much further and making borrowing much more expensive for those economies. And that's something that other central banks don't have to deal with, and it does create an additional constraint on the ECB in our view. So ultimately, we think that will make it hard for the euro to rally. We actually think the euro is likely to fall to parity through the course of this year against the dollar. So look, when I sum it all up, I think there are two key themes to think about for FX markets. What's happening with global growth? How does that impact risk sentiment? That still seems to be in quite a negative trend at the moment, and it's hard to see the positive catalysts that get us out of that. And on the monetary policy tightening front, we still think the Fed will be able to deliver a relatively fast and aggressive tightening cycle, and that should keep the dollar on the front foot over the rest of 2022. Thanks very much, and enjoy the rest of the conference.
Thanks to all HSBC speakers for these insightful comments and views. Now let's move to our next session on TP, presented by Arend, the largest law firm in Luxembourg. They will cover the last trends in transfer pricing, disputes, and how to resolve and avoid them if possible. You know that tax remains a major concern after the crisis. ATEL 3 and Deborah are coming, and we will still have many treasurers not fully ready for tax control on transfer pricing. Time to move and to make sure that you are ready. The presentation will be made by Alain Goebel, partner at Arend Medernach, and Danny Beaton, senior counsel at Arend 2. Daniel, Alain, the floor is yours.
Hello, and thank you for attending our presentation. My name is Alain Goebel. I'm a tax and transfer pricing partner at Arendt, and I will be joined today by my colleague Danny Beaton, who is our senior transfer pricing economist at Arendt, to speak about transfer pricing disputes. Arendt has supported ATEL and its events for several years, and we appreciate that it is an important forum for Luxembourg Treasury specialists. We at Arendt, we have a special full-service transfer pricing team with a focus on transfer pricing issues, and we are pleased to share and discuss our latest observation and technical solutions in Luxembourg with you today. By the way, an article linked to this presentation will also be published in this summer's Treasurer magazine. Our agenda is quite simple. After summarizing our broad themes, we will use some example to illustrate the trends in Treasury transfer pricing litigation, and then review the options for resolving and avoiding controversy in this area. We will finish by drawing some brief conclusions and recommendations. Danny, the floor is yours.
Thank you, Alain. Before we go into some particular transfer pricing cases in the Treasury field, it's useful to look at the general trends in transfer pricing litigation in this area. So if we go on to slide 4, we can see that transfer pricing cases commonly relate to loans and cash pooling, with challenges typically concerning the amount of debt, the terms and conditions of loan agreements, including the interest rate, the appropriate reward for cash pool leaders, and the interest rates on cash pool credit and debit balances. And going on to the next slide, for Luxembourg, we've summarized a recent landmark case in which we were involved last year, which provides a good illustration of the kinds of challenges that can be made and how the courts in Luxembourg may decide on the matter. In this case, a Luxembourg company financed a participation in an Irish company, partly by equity and partly by a profit participating loan, or PPL, in a 15 to 85 equity to debt ratio. The PPL had a fixed and a variable interest rate component, and the interest in total corresponded to a maximum of 99% of the net profits. The LTA argued that as the investment was 85% debt financed, 14% of the interest paid was a hidden dividend distribution subject to 15% withholding tax. However, the interest rate benchmarking report justified that the interest that had effectively accrued on the PPL was not above the usual range for a comparable fixed interest rate loan in the market. And the Administrative Tribunal of Luxembourg confirmed this conclusion. It confirms generally that the size of profit participations must also be the subject of a transfer pricing analysis. Two older Luxembourg cases have emphasized the importance of having an appropriate transfer pricing documentation in place from the outset. And turning to slide 6, this addresses a 2018 case in which a Luxembourg company charged a 12% interest rate, whereas the tax authorities calculated a much lower rate. The taxpayer produced a transfer pricing analysis that had been prepared after the assessment, but as it justified the tax administration's rate as well as the taxpayers, it was held not to disprove the tax administration's argument. The taxpayer then had a second transfer pricing report prepared, which only supported its own interest rate, but because it produced a different result from the first one and was held to produce two contradictory results, both reports were rejected. Turning to slide 7, in 2019, a Luxembourg company had waived and depreciated outstanding shareholder loans, and the LTA said this had created a hidden profit distribution. On appeal, the administrative court decided that since the taxpayer had provided sufficient evidence that the subsidiaries were without activity and were financially distressed, and that loan waivers like this were not unusual, the waivers did not constitute a hidden profit distribution. Now, if we turn to slide 8, this year we were involved in a case which was not directly about financing, but still has important Luxembourg transfer pricing implications. The LTA challenged the related party royalty payments which the taxpayer was making. First of all, trying to avoid the transfer pricing arguments completely by saying that the licensor was not the economic owner of the intangibles because of the functionalities of the licensee. Next, the LTA challenged the validity of the transfer pricing reports because the taxpayer had paid for them to be prepared, an argument which, if generally accepted, would have profound implications for the transfer pricing advisory business. Thirdly, the LTA argued that the arm's length principle could be applied in this case, even though the transactions took place before the amendment of Article 56 of the income tax law in 2015, saying that this is because it is enshrined already in Article 164.3 ATEL on hidden profit distributions. The court agreed on the last point, but not on the first two arguments. So it was a win for the taxpayer. Now turning to slide 9, outside of Luxembourg, other European cases have involved, for example, debt waivers and guarantee fees and cash pooling. This is a case last year where the National Tax Tribunal of Denmark published its decision in the case of H. Borrower and Lender. The taxpayer made an acquisition with the help of a related party loan. Subsequently, it placed its occasional surplus funds from its ongoing activities on short-term deposit in the group cash pool. It paid a margin on its loan, but received no margin on its deposits. The tax administration argued that a margin should have been earned on the deposits so as to reflect the credit risk of the group treasury company. Furthermore, it argued that the group treasury company performed few functions so that it should have received a cost plus fee for any services provided rather than an interest margin. And it argued further that as the taxpayer did not in fact need access to this occasional additional liquidity, it did not need to pay for the cash pooling service at all. Thus, there was no benefit to the taxpayer of using the cash pool, and therefore no reason for it to give up interest on its surplus funds. And this argument was accepted by the tribunal. Thank you. I'll pass back to Alain.
Thank you, Danny. Now, turning to the options for resolving a transfer pricing dispute. This is the case when you face a transfer pricing dispute. What could you do to resolve them? Well, in order to develop a proper transfer pricing defense strategy, we would recommend that you would follow basically a two-step approach, which consists of the following. The first step is to understand the local tax audit processes and to respond to the tax authorities in an appropriate manner for the relevant jurisdiction. This means knowing in advance what the tax authorities typically expect from taxpayers and how do they expect to get the information, what's the language that should be used, and so on. The second step that we recommend is to determine the procedures that are available to resolve the transfer pricing disputes and to eliminate double taxation in that relevant jurisdiction. These procedures include, of course, the mutual agreement procedure, or MAP, and in some cases, advanced pricing agreements, APAs. Now, starting with the MAP, there are basically three sources that can be invoked. The first one is Article 25 of the OECD Model Tax Convention, and which is typically also present in the relevant double tax treaties between the relevant states, where the Model Tax Treaty provides for a MAP procedure where basically the taxpayer has to introduce a request to the local tax authorities within the first 3 years of the first notification where the double taxation issue arises. The tax authorities then investigate this claim. They can ask questions to the taxpayer, and once the factual background is clear, they can decide either to provide for unilateral adjustment so that the issue is solved, or they contact the other tax authorities of the relevant states and try to find a solution to solve the double taxation. For European countries, there are two other sources. There's first the Arbitration Convention of 1990, and secondly, there is the European Union Directive on Tax Disputes Resolutions from 2017. It's Directive 1852. And as opposed to the mutual agreement procedure under the OECD Model Tax Convention, the Arbitration Convention and the European Directive, and that is the big difference, they oblige tax authorities by different means to find a solution to solve the double taxation issue, which is typically not the case if you intend the action on the basis of the OECD Model Tax Convention. So what are the statistics? Well, basically 75% of the maps are solved, at least partially. And on average, the downside is that the procedure is quite lengthy, because in average it took, in transfer pricing cases, at least 35 months. The top jurisdictions that are active in MAPs are shown on the next slide, where you see that typically you have big countries like Germany and France and the UK that are on the top of the list. On average, 55 of the MAP cases result in a full emulation of double taxation, which might be a reasonable price to pay for a 3-year average process. Now, turning to the APAs. The APAs could be a solution to resolve a transfer pricing dispute, an active dispute, if the relevant countries accept that the APAs can be rolled back to previous years, which is sometimes the case, I think, for Switzerland and other jurisdictions. But most jurisdictions, such as Luxembourg or Germany, they don't. So basically an APA is, as the name says it, it's an advanced pricing agreement. So you have to disclose all the facts to the tax authorities before the transaction and hopefully get a confirmation from them before the transaction is actually consumed. For those countries that allow for a rollback to cover the previous years, it could, however, be envisaged as a tool to resolve existing transfer pricing audits or disputes. The OECD Model Tax Convention commentaries basically encourage taxpayers to use APAs and incite them to use this tool actually to solve transfer pricing disputes. One has to admit, however, that in the last years, at least in Luxembourg, the number of APAs has significantly declined, although we see more and more a trend that maybe turns towards an upside again, and that more and more APAs will be found over the next years. Now, let's turn to the options for avoiding a transfer pricing controversy. Now, this is not the case where there is an actual dispute, but this is basically to avoid any dispute with the tax authorities. And in order to do this, well, there are basically 3 things that need to be kept in mind. The first one is that you need, first of all, a robust transfer pricing documentation from the outset. Certain countries, such as Luxembourg, basically accept that the transfer pricing documentation is only drafted and prepared once the dispute arises. But this is something that we would definitely not recommend, because there's also the issue of preparing the transfer pricing documentation ad hoc when a certain amount of time has lapsed. You are not sure to have all the information right away. There is time pressure because you have to respond in a certain time frame, and you are not sure of the result. So you're not sure that you're going to match the result that you wish to have. So the recommendation would definitely be to have a robust transfer pricing documentation from the outset. Now, the second are you need to have a robust transfer pricing policies, and you have to follow those policies. What we see very often, again, is that there is a transfer pricing documentation, there is policies that are in place, but they are not necessarily followed. And if the behavior of the taxpayers and if the legal documentation of the taxpayers does not match the policies, then it's extremely easy for tax authorities to dismiss the case and to win. Lastly, the question is, what about an advanced pricing agreement? An advanced pricing agreement has basically as an advantage to avoid any future transfer pricing disputes. What we see there is that unilateral APAs, for example, only an advanced pricing agreement with the tax authorities of one relevant state, they have become less common, at least in Luxembourg, because the value is, however, limited, because it still doesn't bind the other country. So if one considers an APA, it would be rather a bilateral or multilateral APA that would need to be considered in order to give an effective protection against a future dispute. The downside is that bilateral or multilateral APAs take a certain amount of time, and typically they take an average of 32 months in the EU. Although Luxembourg seems to be quite fast because it has an average of 16 months, which is roughly more than a year. The jurisdictions that stand out for bilateral or multilateral APA is Belgium, where half of its advanced pricing agreements in force are not just with other jurisdictions, but also with other jurisdictions in the EU, but also with jurisdictions outside the EU. In fact, Belgium accounts of all the European Union advanced pricing agreements with non-EU jurisdictions. APAs will, however, not be a solution for all taxpayers or transactions. This is because they require a significant commitment of time by tax authorities, and tax authorities need to be willing to enter into the discussions with the other tax authorities and spend time on it, and really wanting to get to a solution for both countries, which is not always possible and which is not always achieved. There are no time limits and there is no obligation under an APA to find a solution. This means that small or simple transactions, such as plain vanilla loans, may or may not be considered, or even if large and complex transactions where the taxpayer is seeking a unilateral APA, but the tax administration suspects that the other tax authorities will challenge the pricing and the MUP will result from it, negotiating the benefits of the APA. One has, however, to consider that APAs might not be an option for all taxpayers or all transactions, and this is mainly due that the negotiation of the APAs depends largely on the tax authorities, and they must be willing to negotiate, to spend time and to find a solution. Also, as opposed to MAPs under the Arbitration Convention or the European Union Directive on Tax Dispute Resolutions, there is no time limit and there is no binding obligation for tax authorities to find a solution. In conclusion, there is now more focus on Treasury transfer pricing and more likelihood of challenges, as you've seen also by the examples that Danny has given. However, robust and well-documented benchmarking reports, transfer pricing procedures, checks for internal consistency, and the use of the MAP and the APA options can greatly reduce these risks. Thank you for your attention and enjoy the rest of the conference.
Thanks to Alain and Danny, who are always keeping our member updated on this tricky topic of taxes and TP. Now let's move to an interview of Philippe Foster, partner at PwC Luxembourg, IFRS, Treasury and Payment Institution. Philippe, your turn. Okay, so now let's start to talk about the trend in Treasury. We will base our discussion with Philippe Foster, partner at PwC in charge of IFRS and Treasury, about a recent survey, a global survey made by PwC. It's interesting to talk and to comment the result of the survey. We will also talk about the EACT survey. It's quite similar in terms of result. Also to compare what is the perception from CFOs compared to the perception of treasurers. And we will talk about other key issues like regulation. So, Philippe, first question, what is the main differences you have noticed in this global survey between the perception from CFOs in terms of priorities for Treasury and the head of Treasury?
Thanks, François. So back to our classic agenda section. I think there are obviously some differences. Now, I may say that those agendas are quite similar. I think differences came from the fact that it's two different jobs, right? If we can say that Treasury is a kind of stewards for cash flows, the CFO is more global finance, just to simplify. So it would make sense to see on the agenda M&A, tax optimization on the CFO side and not directly on the Treasury side. Now, what is surprising when we look at the agenda is really the fact that talent management is really a concern for CFO, but not for Treasurer. And honestly, in Luxembourg, talent management is a key concern. And what we observe is, honestly speaking, talent management is a European, if not worldwide concern, whatever your industry, whatever your function, I would say. So this is one surprise. And the other one, which is going the other way around, is to say financial risk management is a key concern for Treasurer, but it does not appear on the CFO agenda. So I don't know whether on the ACT you've noticed the same discrepancy, but this was quite surprising on our side.
At EACT survey, we were not questioning CFOs, so we don't have this kind of, let's say, major difference. But just to comment your point, I totally agree. So the first one is talent management, the second one risk management or financial risk management. I would say talent management. I'm also surprised when I saw the result because today we clearly have a quest for talent. It's difficult. We see an inflation of salaries. It's difficult to find, even in countries like Luxembourg, where we have financial services and an industry around financial services. It's difficult to find the right profile. We have the big resignation. It's difficult to move people. A lot of people want to work from home, so it's a major issue. I totally agree. I'm surprised, as you did, not to see that in priorities for treasurers because it's difficult, and when we discuss with our members, they have an issue with that. And the second point, financial risk, I'm also surprised because it's a classic one, I would say. Every year, every 2 years, we have in surveys in the top 3, exactly. And this year it's maybe a step behind to compare to the ACT, it's number 4, but still it's very close to the number 3. So it means that financial risk management and FX risk are in priority, followed by interest rate because of the inflation and the increase of interest rate are top priorities. I guess you agree.
Yeah, sure. And you know, I mean, bouncing on those top priorities, we've been here focusing a bit on the differences, but I think a very important message is when you look at liquidity and cash management, capital funding, IT investment, those are really top priorities on both sides. And I mean, you know, this is important to notice is there is a clear willingness to go ahead and to improve operation, to gain efficiency.
Yeah.
And go ahead.
We have to notice that the 2 major, let's say, lessons learned from this crisis or crisis in Peru, because we have now the war in Ukraine at the door of Europe. First, it's more centralization. And second, it's more automation. It's quite important. And let's move maybe to the second point, to the major and key priorities. In your PwC survey, you have 5 major trends. Maybe you can list the 5 trends and comment each one individually and see. And I will comment if there is some, let's say, convergence with our result at the ACT level.
Sure. So. I think, of course, despite the very high level of reactivity that is requested and required from the treasurer, and analyzing the answers we received to the survey, we've identified 5 priorities for Treasury. The first one is business partnering. The second one is raising digital acumen, where we can have the link with, you know, the IT question we just talked about. Obviously, driving ESG, I think there is a clear opportunity for Treasury to position himself in there. optimize cash, which is very key and I think has been on the agenda since years as well, and the financial risk, which is still a huge priority. Now, if I need to give a kind of flavor, a bit of explanation of what's behind, and starting with the business partnering, I think with COVID, people have realized the importance of being connected with the business, just to update the forecast, just know where is the cash, how to react, how to assist the sales team, the recovery team. So this is now something where CFO expect the continuum. They really want Treasury to leverage on that and to really become the business partners, Treasury have always wished to become. So this is the first part we've noticed. Now, can you do this without a proper tool? Probably not. So when we say priority number 2 is raising digital acumen, it's really looking at your IT architecture, making it as efficient as possible, is maybe trying to find small niche solution for your receivable recovery, for your cash forecasting, for maybe some just cash analytics stuff. So it all depends. But really, I think with all RPA, artificial intelligence. Yeah, thanks for that. Which is coming in and really providing good solutions. There is a clear trend to go in there. Now, third one is ESG. So I think as of today, and I believe it's a really good thing, every single corporate have committed, right, to net zero, or they want to have clear plan for the S and the G side of the ESG equation. So if we first focus a bit on the E one, on the climate one, for instance, Treasury has a role to play because in terms of excess cash investment, you now have green solutions which are provided by bank, like green deposits,
money market funds.
You may have as well some supply chain finance, where based on the ESG scoring, the price applied will be different. And of course, you may help as well to assess the green side of your financing. So I think here ESG is not only about knowing what the IFRAG is issuing currently or the ISSB and so on and so forth. It's really about on your day-to-day area. You can really contribute and you can be part of the discussion. While optimization of cash, I think this is clear. It has always been on the table. Rationalization of bank account is still a topic, and with all those technologies, new players coming in, I think it will remain on the agenda for quite a long time. And of course, as you mentioned, we have now inflation. We had, of course, as well linked to inflation and other events, but we have volatility in commodity price. We have commodity in FX. So making sure your margin is secured is something which is really, really key as well.
No, if I want to comment from the ESCT side, I would say that if we go to the business partnering, what was not really identified by our members across Europe, but I totally agree. So where could we create value with by better partnering with our operation on working capital? You mentioned on FX by let's say invoicing or be invoiced in the local currency of the counterparty. Maybe you can, but it requires to centralize the hedging. By doing a lot of things to smooth the process, to accelerate, and to certainly help the supply financial chain. Coming back to the point of raising the digital acumen, I totally agree. So we have noticed that a lot of corporates are still using the same TMS for 10 or 15 years. So sometimes on-premise, not a SaaS solution. So a lot of our colleagues and peers are now, let's say, reconsidering or revisiting the complex IT architecture and revamping the system, or let's say launching a RFP for changing the system with SaaS solution, because all solutions they are quasi all SaaS, and to see how to better use what we already discussed before, the new technologies, the new fintech, to get a better and more comprehensive and better tool. ESG, no comments. So it's obvious that in Luxembourg we're well placed with the green bonds, specialty of the country and everything. And we also mentioned at ATEL several times the money market funds with a new reform, the new taxonomy also. It helps having really, we try to avoid the greenwashing, what was a big issue for the corporate treasurers. Coming to the last 2 points, so optimization of cash, it was our first one. So when we say optimization of cash, it's also cash flow forecasting, etc.
Totally.
Clearly, with you, it's still number one for treasurers. And the last one was the financial risk. We mentioned that fixed risk was number 4, slightly behind, but still quite important. The major, or maybe this whole difference I see compared to your list of priorities, it's maybe bank relationship. You mentioned it, but bank relationship is quite important. It's number 3, and realize, but maybe it's linked to the problem of liquidity, that having strong and solid relationship is quite important when the storm is coming, because you need to maintain your credit facilities or to extend your credit facilities, and then you need a good relationship with your partners.
Absolutely, and I think this is something we've mentioned in the previous video. Is, you cannot just go and select the cheapest bank. You really need to think about your whole relationship and who will be there. Now, maybe one point I'd like to come back on is really about the IT and the digital acumen, because you're right. You mentioned, we have a lot of companies going to those new fintech solutions and so on and so forth. We know that the payment world is really evolving. We have a trend to go towards treasury on demand. Now, is every single company, corporate, ready for treasury on demand? Of course not. I think we're not yet there, but it's possible. So where do you start? And we mentioned, okay, of course, your IT architecture, just listing your solutions, seeing which one is still relevant and so on and so forth. But we need to focus as well on the data, because as of today, you mentioned spreadsheets, you mentioned several solutions, complex environment. But I think even in the data, it can be chaotic. And before going on a new solution, trying to find some artificial intelligence or RPA, really you need to clean your data, to harmonize them and standardize them. Because otherwise, I'm sorry for that, but garbage in, garbage out, it will not work.
Exactly, no, I totally agree, because what we notice, and again, it's something that's shared by all our members across Europe, the fact that we, at the end of the day, we use tools and we export or import Excel data that we recrunch and then refeed in systems. So at the end of the day, we always pass by via Excel, and what we have noticed, paradoxically, an increase of Excel spreadsheets. So, and one of the recommendations I could say to our members or to treasurers, so why not having a sort of diagnostic of the current situation before launching project? Why not having a sort of what is the solution as is? What could be the improvement, and then to define what could be the roadmap. And I really encourage our member, I don't know if you agree, having this kind of first overview diagnosis before launching project, and say, okay, I'll change the TMS, I'll change that and that, without having a global vision of what will be the whole building, rather than changing pieces one after one.
I can't agree more on that. I think people, tend to think that it's a very long process, but honestly speaking, a diagnosis can be short. It's not expensive. It's really discussion based, and it's interactive. It allows you to say, okay, where do I start? Yeah. What's really important? How do I align with the strategy of the group? Is there, stupid question, but you tend to say, okay, I need a new TMS, but maybe your group is currently looking for new ERP. Can you leverage on that?
Yeah.
So of course we can provide benchmark with top players, organization, new trends, centralization ideas, and so on and so forth. So yes, I would really encourage everybody to start this discussion.
What is a good system, etc.
Totally.
Okay, excellent, interesting. Maybe a last point that we need to discuss. You will agree. Regulation is also not a key priority, but something that we have to stand in to accept. And usually after crisis, you will agree that we have new regulation to correct what went wrong.
I think, for the past years, with or without crisis, we had new regulations, and it's still coming in. So I can understand that people are a bit afraid about that, and say, yeah, one more, or again, a new amendment. It's true that it's coming. I think, we have the money market fund, which is on the table. We have the review of the Basel agreement arrangements for the banks. So this will impact as well the day-to-day work of the corporate. Of course, we have IBOR reform, which is still there. Mm-hmm. So there is a lot. I think, what are the impacts? probably an increase in your cost of hedging, maybe less available solution if you want to invest your excess cash. Interest are increasing, so might be less of an issue, but still, there are some things. So yeah, it's an additional point to keep, I would say, to keep on the agenda somehow and to consider. But I guess you've been, asking questions around that in your survey. So do you have any?
Actually, not really, but we realized that maybe we should inform the member, because for EACT it's quite important. You know that EACT play one of the role of the European Association of Corporate Treasurers is to make some lobby. I don't like the word, I would say advocacy, to try to influence the regulation. And as we say, we have always regulation, but now we have a wave or a new tsunami of regulation. A lot of regulation are on the review. We mentioned earlier on
some of them,
PSD 2 on the review, coming potentially to PSD 3. I forget to mention also taxes with DEBRA coming, capital market unions. So we know clearly that they want to be less dependent from banks, more depending from capital markets. They would like to reduce the undercapitalization, to increase the capital and equity in companies, and to reduce the bank borrowing. So DEBRA will be clearly giving some incentive and disincentive for that. In payment, we've mentioned money market funds. You mentioned with the ESG, of course, taxonomy, new reporting. Liquidity management, so we have hedging with EMIR on the review, so we have many new regulations. You mentioned Basel III, because Basel III will have extremely great impact on cost of guarantee, so for people selling planes, train, metro, or big equipment, long-term contract where you need to issue some guarantees, standby, etc. It will have an impact on their capacity to raise debt and the cost of debt. So cost of hedging you've mentioned, and so on. So the list is very long. And for those who are interested, on the EACT website, you will see that we have identified 15 key regulatory issues and changes that would potentially impact our activities. And of course, digitalization is quite important to make sure that you stay compliant and you produce a report requested by the regulations.
Totally, and still in there, I think we touched base on ESG, saying in your day-to-day investment and so on. But I think in terms of regulation, there is a role to play as well, because when you deep dive in those regulations, you will quickly notice that it's not about adding a new disclosures. You really need to explain to the readers of your reporting what you want to do, what are your targets, where you are compared to your target, what is your plan of CapEx, what is your expected OpEx. And so in there, it means you need to get some financing for that. Mm-hmm. So it's a kind of, you have your business plan, you need to consistently have a kind of green business plan to answer to those disclosure requirements. And I guess Treasury has a role to play there as well.
But let's see the positive aspect of all these regulations. It may be the good argument, the good reason, or the good pretext to sell to the CFO and to the C-level investment in digitalization, because it's one of the conclusions of both surveys, that we need to be more digital. Whatever the priorities, it's in the top priorities. Number 1, number 2, number 3, whatever, but it's still important for us.
And we'll get to those priorities with the diagnostics. So.
Exactly. So I keep thinking that it's a good recommendation, and certainly if we have a takeaway to give to our to the audience, to the participant of the conference, we should certainly advise to have this kind of external diagnosis first before launching any initiative in terms of digital investment. Because I think that it makes sense to have a certain perspective rather than changing piece after piece, especially in light of what you said, the better use of information and data or data lakes. We need to structure that to make sure that we can do that. So any maybe final comment, Philippe?
So very final one, I think, in the previous survey, we were saying it takes 2 to tango. I think it's still very valid. So we were talking about diagnostic, we were talking about IT investment, and one more time, I think the link here, you cannot just look on your tool. You need to as well consider your organization, the new regulations, where you want to go. So I think, yes, you need a partner to do that. We're happy to assist, of course.
Thank you very much. So I hope you enjoy this session. Thanks.
Have a good day.
Thanks to Philippe for this valuable comment on the current trends in Treasury and hot topics. There are many, as we saw. I'd like now to move to the last panel session together with Visa, PwC and HSBC. In this panel, we will address the modernization of cross-border payments and the new e-payment methods and how the sector is disrupted by the newcomers. The cross-border revolution, how we will reach a friction-free experience. That is a challenge ATEL has identified and is pleased to address through this interesting panel. With this globalization, although today we now talk about deglobalization after COVID and Ukraine's war, the goods and services are crossing greater distances, and the demand for cross-border payments that are as seamless and convenient as domestic ones keep on increasing. This path will not decline. Conversely, it will keep growing. For a long time, the cross-border payment industry was stuck in the dark ages with outdated models, but technology continues to develop rapidly, and the progress in the revolution is only at the beginnings. We have to admit that the emergence of fintechs and the new technologies applied to finance and treasury helped. Several initiatives exist to transform the international payment landscape. The FSB, the Financial Stability Board, is an international body that monitors and makes recommendations about the global financial system. PSD2 is under review and could generate a PSD3 very soon. The G20 endorsed a roadmap for enhancing cross-border payments, and it is on their priority list. Their roadmap addresses four main challenges: high cost, low speed, limited access to information regarding your payments, and insufficient transparency on the fees, among other things. The involvement of the private sector to share insight and practical expertise, as well as to deliver changes, is key to support the practical implementation of the roadmap. Multinational companies are working on cross-border payments, take part in conversation and thought leadership on solutions. They implement responses. However, we can ask you to share with us your own thoughts and views on these issues. Now let's start with our first question to the panel. Let me introduce our three panelists. Philippe Foster, partner IFRS and Treasury at PwC Luxembourg. Philippe Versluis, Business Development Director Europe at Visa, based in Brussels, and Nick Ashton, Country Head Luxembourg, HSBC, Global Liquidity and Cash Management. Now let's start with our first questions. So the first question for you, Philippe, PricewaterhouseCoopers. So who do you see driving the modernization, customer demand, technology, regulation like PSD2 or soon PSD3, supplier needs? Can you share with us your view on this?
Yeah, sure, François. It's quite a long list, but I would say all of them actually, because if you think about what can come from customer side, then you may think about small issues. I mean, issues treasurers have, for instance, in cash forecasting, and then they may seek some niche solution for that. You may have as well, the trends we observed, which is going to on-demand treasury, which then requires, of course, a more advanced technology and a different landscape. So a lot of modernization. Talking about that, I think technology obviously has a role to play. We can take a very classic example, blockchain, right? Came somehow out of nowhere. Now people have business use case around that. So of course it helps as well to build the, or at least to go ahead in modernization. And we cannot forget regulation. I think PSD2 brings in API. PSD3 will hopefully bring a standardized API, some solutions for fraud. And SCA among others, but then I think it's a full ecosystem, and every part of it has a role to play.
Okay, so maybe a question for Unique, and after I would like to have also the comment from Philippe. What is the opportunity for cross-border business growth? So how do you see this huge and fast-growing market as banker and as financial services?
Yeah, absolutely. I mean, a key part of our business is really helping customers banking in Europe and in Asia. So the cross-border payment space is massively important for us. And anything, whether it's the SWIFT GPI or some of the real-time information that we do, anything that makes that a better experience for our customers is good for us. And I think, you know, as we make the business less friction, we can do more. And actually, the more we can do, the economy grows. So it's the right thing to do from a macroeconomic level as well. And I think that's where we really see the opportunity, is that by enabling that cross-border trade, making it simpler for treasurers and giving them access to the information quicker, and especially, as you mentioned, like the development of the APIs to make 24/7 information available for tracking. That just makes it easier for everyone through the chain. And if it's easier, you do more of it. And frankly, yeah, that's great for everyone.
Yeah, just to pick up on that, I think absolutely agree. Clearly, we've seen enormous growth in cross-border, and we expect that to continue. I think there's some inherent opportunity to further simplify. We also see a lot of more collaboration and partnerships, right? I think the advent of technology, but also various different sort of participants in the industry. Obviously, you have the banks, the neobanks, fintech, financial service providers. So it's becoming a real sort of interesting mix of experts in their domain, and I think that's where, certainly in cross-border, there's the opportunities to collaborate and really look at all of the inherent challenges in cross-border and then sort of look at that from a business-first perspective, right? Starting with our clients and really look at sort of how these partnerships, that collaboration can really improve the experience.
Okay, maybe another question for Unique. How have cross-border payment modernized so far? You mentioned SWIFT GPI, but we heard from SWIFT that GPI is really a success. So we have new actions like StoneX for exotic currencies and others, other new concepts. So what is your view on that, let's say, new developments?
Yeah, I mean, I think you're right. SWIFT GPI for us has been a game changer. I mean, this industry is something that the cross-border payment space, especially with correspondent banking and MT103s, we all know the challenges with that, and I think it's important to remember that how much SWIFT have done already with SWIFT GPI and the ISO standards to enable us to really give that transaction banking in a consistent way. Again, through the APIs as well, which really makes it a much more seamless proposition. But I think there's clearly more to do, and this is why, for me, from a banking perspective, it's really great to see the new entrants in the market. I mean, I think SWIFT will continue to adapt. At the end of the day, it's a standards organization. It's not a channel, it's not a technology stack in itself. So I think more competition, more innovation in this space, it improves the playing field for everyone. So I think that's really where I can see it going, and I think SWIFT will get better. They'll build on the work with the GPI and the ISO standards. That standardization that you mentioned, I think, is really helpful as well for everyone. But I think new players, new entrants in the market, new technologies is clearly great for treasurers.
And so, any view on what the future would look like? Because you mentioned the new player, so the new player could be a booster for SWIFT to keep innovating.
Yeah, absolutely. I mean, like we said, we're seeing like credit card companies, coming in, for example, and using that sort of use case for using like a virtual card proposition, for example, for payments. So it doesn't have to be the classical sort of MT103 or wire messages. There are things like virtual cards that actually can make a cross-border payment as well.
Whatever the form. Good. Question for you, Philippe. PricewaterhouseCoopers, because we have two, Philip, and to Nick. How do you see the financial ecosystem evolving with the open banking you've mentioned, the neobanks you also touched upon, and the fintech, and also the new player, because we have really a new ecosystem, new entrants, giving more option to corporate treasurers, and we should also participate to this new development, I guess.
Yeah, totally. I think, somehow answers have been given. Nick, you mentioned, legacy players adapting. This is part of the story. Another one is, of course, those new players coming in. Now, how the financial ecosystem evolves, it's a kind of hard question because it's pretty broad. I think we can mention that, several forces are there to influence. So just to mention some of them, of course, broadly speaking, we have more and more alternative capital providers who play a role in that financial ecosystem. ESG, of course, will change somehow to who we grant credits and what are KPIs, which are currently on the tables. Now, of course, coming back to the payment world and so on, I think the client-driven shift to platform is something that will have a huge impact. And of course, the overall ecosystem with APIs, somehow the API economy, which is there, is really booming and taking a lot of space, I would say. In there.
Okay, so maybe let's move to the next question. A question maybe for all of you. So, how is the financial data lakes, because we have a huge data, playing in creating better experience for clients? How to make better use of them? We now have a new ISO 20022 you mentioned, new standards. We have compliance requirement, open banking, open doors, as you would say, thanks to the new APIs, and therefore access to data. Potential use of the LEI for payments. It's something that is being addressed by the EU at the moment in the PSD2, but it also comes with more fraud and cyber risk. So what about the IT security risk? And do you see a role in co-creation between actors, including banks, fintechs, but also we as corporate traders? I don't know who want to shoot first.
You wanted to?
Well, just okay. A quick remark. I think ISO 2022 key initiative in the industry. But I think everybody would agree, data is just a means to an end in the end, right? Is to really look at that from how can I use that richer data, the additional reconciliation possibilities, and as an example, and obviously in fraud, looking to optimize that as well. Back to that sort of data. I think the one comment I would make is, given that sort of cross-border area and the inherent complexity of multiple jurisdictions, I do expect sort of a lot more to be done in the harmonization across jurisdictions, right? I think it's not a trivial exercise. Back to your introduction around the work, for instance, by the FSB, sponsored by the G20, I think is a really important role there as well on the policymakers, and really to, again, work together towards that sort of most logical way of sort of looking at that across borders, right? And so my expectation is it wouldn't sort of be an end. ISO 2022 is really sort of, again, one of those evolutions, and that collaboration and this sort of continued working together will remain as a key underpinning.
Yeah, so if I may, I think I of course echo what you've just said. Maybe on top of it, I think the granularity of information of data we have in ISO 2022 will, or should at least, help in AML KYC. It should speed up the process. I think it should bring automation in ensuring through those different regulation in the correspondent banking chain to speed up a bit the compliance check and so on and so forth. So I think it's very good news, and indeed those data can be used to for the customer experience, but as well for the speed and the cost of the transaction as such.
Yeah, definitely. And for us, I mean, we see this in sort of two opportunities here. So one, with our own proprietary data and our own proprietary systems, we're developing tools such as cash flow forecasting. So being able to use customers' transaction and balance data to provide a cash flow forecasting tool to the customer, and that's available for our own proprietary e-channels. But also we're working with the fintech ecosystem, because again, through the PSD requirements and the APIs, we can actually make our data available to some dedicated fintechs so that they can then go on and create or co-create, if you will, using our developer portal, software that meets the needs of treasurers. So I think that for me is where in this treasury space, that is so important, because we, the bank, can make our data available, and then someone else who, we do our best and we build software and we try to build software for our clients, but we're not a software company, but others are. And actually this enables the software companies to build some really nice tools specifically for treasurers, and our data can be a part of that, which I think is hugely exciting.
Yeah, and talking about that, if I just may, because we're not yet there in terms of instant cross-border payment, so the possibility to track the payment thanks to the new ISO messaging is something very important to mention as well.
Definitely.
Another question for all. Do you believe in one solution that will solve all issues? Maybe wishful thinking, I don't know.
Thanks for looking at me, guys. I like to say, and I'm not the only one saying that, so it's not my sentence, but innovation requires collaboration. And when we talk about collaboration, of course, there is no single one solution. We mentioned ecosystems, we mentioned collaboration with fintech, we mentioned APIs, the whole economy. So honestly speaking, I guess the answer is simply no to that question.
But the motto will be co-creation. We should co-create
obviously
solution of the future.
I think if I just made I think co-creation and unbundling of capabilities, back to your points as well, right? Allowing that sort of best of breed of multiple provider solutions. So clearly, I think we'd expect that as well. Choices, which then drive sort of further innovation. So I think that's going to be the new world.
Definitely.
Okay, maybe a question for you, Philippe, again. Besides the challenges addressed in the G20 roadmap I've mentioned in the introduction and you mentioned, do you see other points where value can be delivered to our customer, to your customers?
Well, I think there's one real important aspect. So obviously, I think clearly we at Visa, we support, we also engage that roadmap on the building blocks, cost, speed, access, transparency. I think really all are important. The element that we'd love to sort of ensure that sort of remains top of mind is also security and reliability, right? Because I think you'd always have to look at that from a core perspective of enough investment in the platforms, in the technology. You mentioned AML and fraud. I think the reality is that we can drive a new customer experience, but security and reliability are really sort of top of mind.
Speed should not be at the expense of the security. Yeah, I totally agree. So next question. Always API technology improving the customer experience is quite important. And what are the opportunities in the future? For example, with banking as a service, treasury as a service, outsourcing new techs. What could be the role of banks and financial services in this new landscape, or with more players? What about the other financial players we can imagine, which are not necessarily neobanks? And Visa is a good example.
I think for me, clearly picking up on some of the themes, I think APIs, if done well, allow you to scale and really look at sort of a new way of operating whatever is required to run your business, right? So it still remains technology with a focus on optimizing business, but I think it does allow for much more flexibility and to get to these capabilities, which again, sort of combining, I think that's important. At Visa, we've taken that sort of API first approach across our platforms. That said, there's always this aspect of integration into what is then often called legacy as well, right? So I think that's becoming more and more also an interesting perspective of the newer breed, newer providers, newer companies, all focusing on the APIs, with lots of the cross-border industry still on non-API solutions. So I think the opportunity is to really sort of embed and really take care of, sort of take the sort of the elements of the API, but still again, security, reliability, integration into the broader
larger ecosystem.
Yes.
Okay. So another question maybe to all, what are the rewards and opportunities that can bring interoperability between systems? Because it's quite important to make sure that if we have different solutions, it can be interoperable. If we want to go for more automation, what is one of the issues?
Yeah, I mean, from my perspective, it's customer experience. I mean, if the more seamless experience we can deliver, both from an instigating of a payment to right the way through the chain, getting certainty, speed of delivery, If that experience is good, then clients put more payments through us. It's as simple as that. And if a treasurer or an accounts payable team don't have to waste minutes, hours a week chasing down payments, beneficiary claims on receipts, that's a great experience for the customer, which frankly reflects well on us. And I'll be disingenuous to not mention it. If a customer doesn't phone us, that saves us money as well. So, there's a whole improvement from a client experience right the way through to a sort of a real P&L benefit to the financial services institution as well. So it's a win-win, I'd say.
To answer what you just said, I think I fully echo what you say, but I think talking about saving cost, I think interoperability will bring the possibility to share infrastructure. So it means economies of scales. And then we were talking about, speed, cost, and transparency in cross-border payment. I think those economies of scales can touch on the cost aspect of it. Now, of course, cybersecurity is still something we need to pay attention to. I know colleagues of mine are often doing penetration tests, as we said, or intrusion tests. And usually what we observed is within those API, it's from time to time hard to say, is the one asking really the one which have been authorized? So I guess we're going in the right direction, but there are still, those cyber guys, I may say the bad ones, are always there to, exactly. So this is something still to keep in mind.
Philippe, final comment?
One final comment. I think for me, interoperability really allows us to look at increasing the pie, right? And really ensuring that if there's better interoperability, clients will benefit, the ecosystem will benefit. And I think, again, back to partnerships, when things are interoperable, smart people will look at different capabilities, and it becomes really much more of a sort of an easier way to then embed it and expose it to the client. So clearly a key area to maintain and focus on.
Thanks a lot for all these interesting pieces of information and comments. So thanks to Nick, Philippe, and Philippe. I hope that you enjoy this session as we did. Thank you.
Thanks to you, François.
Thank you. Thanks to Philippe, Nick, and Philippe for this comment. Very interesting. I wanted, before closing this virtual summer conference, to thank all our 4 sponsors, HSBC, Visa, PwC, and RN, for the support and participation. I hope you have enjoyed our conference as we did. Have a nice day, and see you soon to one of our next ATEL in-person or virtual events. You are more than welcome. The next one will be early October. It will be our annual conference. Take care and enjoy the summer.